So, yeah, let's start. So, in the previous workshop, in the day one, we learned about the straddles and strangle, right? So, short straddle, long strangle, and we learned about the ratio spread as well. So, today we will learn the other strategies, which is about the covered call. Let me share my screen. So today, let us learn about the covered calls. Okay, covered call is a bullish strategy. By going long in futures or cash market, then selling a one call option will become a covered call. So how to adjust the covered calls? Okay, it's a high risk strategy, and of course there is a lot of options, right? So even though if it is a high risky, we can make it low risk category. So it's all about how much risk we want to take it, right? So covered call is nothing but the definition itself, it says going long in futures. I'll just execute this and show you in the stimulation uh, so that it is easy to understand. Let me share the whole screen. That would be better. Okay. Okay. So let us build a covered call strategy. As I said, so to build a strategy, it's nothing but going long in Nifty and selling the call, right? So let's build the covered call and see what will be the payout. Okay, Nifty, if you go see, and if you are bullish in Nifty and rather than going naked long in the Nifty, so if you see Nifty, if you're trading at 22,333, this is the spot price. So 28th April, let's buy this 22,454. If you buy Nifty here or any underlying asset, it's not only about the Nifty. Okay, if you buy, the probability is 52%. Okay, the margin required is 1,68,000. So the maximum profit is unlimited, maximum loss is unlimited, right? Because the market, if it is sharply coming down, you'll go for an unlimited loss. And if it is going up, you'll have an unlimited profit. So what if you want to cut down? If you want to reduce this 22,004, right? So if you sell a call option, say suppose the call options are always having a premium, certain premium, okay, or a period of time, we will enjoy the decay if the market is not moving in our favor. So say suppose we went long in Nifty, okay, at 22,455. Okay, so what if you want to reduce this price? So why we want to go for a market rate? Okay, what if it is coming down? We can sell 22,388 rupees with 7th April. So again, you can sell weekly options or bi-weekly, next week options or monthly option. So it is usually better to go for a monthly option if you want to keep your position for a longer duration. If you want to keep it for a shorter duration, you can sell the weekly option. So let's see on 28th, if I want to stay long in Nifty for almost around 28 days, we will take an option of 28th April. If you see 22,500 call option has a 751 rupees premium. If you sell this, okay, you see here, your Nifty cost would become 21,700. So even though if you are long in Nifty, okay, and say suppose if the market falls down, still you have a buffer of 2.8%, okay, with the same profit percentage. So usually to sell a call option, you need 1.3 lakhs, right? So to go long in Nifty, you need 1.7. So combined together, you will get a margin benefit, will still remain the same. The only thing is you will go with a limited profit here. Okay, the maximum loss will be still unlimited because if it is falling down, you may get this 750 rupees may become zero, but over and below, like if it is coming below 21,700, okay, then only you will go under loss. So this has a probability. If you see, if we go only long in Nifty, the probability was only 50 to 52%. But now the probability has increased to 60%. Why? Because have sold the call option and collected a premium. So how will be the payout chart here? So on the date of expiry, say Nifty, if it is not moving up at all. So say suppose if the Nifty closes in the same range 22,331, you still make a profit of 24%, even though you are long, the market did up, but you make a profit 40,000, which is 24% of the deployed amount. Say suppose the market came down after you went long. The advantage of having a covered call, like even if the market comes down by 0.5% or 1%, even 1.5%, even it comes to 21,900 on the date of expiry, even 2%, okay, up to 2.8%, if it is coming down, you still make money. Okay, so this maximizes your probability of profit, the probability, and you will have a fixed profit even the market is coming down. But if the market moves up, you will make 30% of the profit on the deployed amount, which is 50. But the profit becomes limited because over and above 22,500, kya ho jata hai? This premium will start going up. So see, you can see here the profit table. So if the market is down or flat, you may lose 8,000 rupees in the futures, but you will gain whole. This 751 rupees premium zero. Okay, this is what we call it as a covered call. It can be applied to any of the stocks. Say not only in Nifty. Say suppose if you want to go and have this strategy in any of the stocks. Say suppose we will just build in any of the stock so that we will see how it goes. Say suppose you want to build this in Reliance. Okay, so as I said, if you have a Reliance, if you want to buy Reliance, okay, Reliance now it is trading at 1354. 28th of April, it is futures, it is trading at 1354. The lot size would be 500 here. If you buy one lot, okay, you can see the payout graph here. So what if the Reliance is not performing? As I said, even if you buy only futures, the probability is only 52%. To do a cover call, you have to go and look at the size. You can see here what is the highest rate. Say suppose if you we went long at 1355, right? 1355, 150 call option is at 50 rupees. 1360 call option is at 44 rupees. 13, we are bullish, but we think that it will not beyond 1400. See, it's nothing but you booking your profit well in advance. Say suppose sell 400 call option. Okay, your buying price becomes 1328. So earlier it was 1355, right? Even if it falls to, if by selling a call option, your buying price will come to, but even if it falls by 1.2%, you will be in profit. Say suppose if you want to still go closer, you can sell 1350 call option. Okay, till 3% down, you will not go under loss. Even if you are in April month futures, if you on the date of expiry or anywhere between, even on the date of expiry, if the Reliance doesn't move, even if it is not, you still make 16% deployed amount, which is 1.26 lakh. Okay, you still make 19,000. If the stocks comes down also, you will be making a profit, minimum profit. And if the stocks moves up, okay, how much ever it moves up, you will make 22,000 profit. Maximum profit is 20. Yes, any questions? Okay. I think everyone has to mute here. Let me mute all. Allow participant. Yes. So if anyone wants to ask question, you can unmute yourself. At present, I have just muted you all. Okay. So this is what is our covered call. Now coming to next. Okay, this is covered call is very simple. Say suppose it applies, it's not only about the futures. If you have say 500 shares of Reliance in your delivery, right? So a lot of people hold in the delivery like Reliance ho gaya, Infosys ho gaya, or any of the are there in future and option. If that stock is not perfect, you can just sell a call option. If the stock doesn't move to that strike rate, you will get that premium as a monthly income. So it is always good to protect capital, in the sense protect your portfolio by a covered call. This will help uh, to get a consistent income even if your portfolio is not performing. Right now, next coming to the caller. What do you mean by caller? It's nothing but a same covered call. It's a bullish strategy. Less risky to compare to covered call. As I told you, if it is high risky, if you just put a collar. So create one covered and then buy a one put option for protection. Okay, continuous adjustment of call option to for the best returns. I will show you how the covered call. As I told you, if you do this, say suppose okay, and here maximum loss is unlimited, right? Okay, so I want to cover this. I don't want to be in an unlimited loss. Okay, so to do that, so you can protect, we can buy one put option. So as we have collected 50 rupees premium here, so you can deploy at least 10 rupees for an insurance. It works out like an insurance. Okay, so say suppose below 1200, I just want to keep a stop loss. So I will buy 100 put option. See, the maximum loss, it reduced from unlimited to 57,000. So whatever may be the market situation, if the Reliance to 1200 and below, then only you will lose only out of, you will lose 56%, but it is covered. So below 1200, it will have the cut off the loss. So this will cut off the loss. Below 1200, you will not go under loss. So this is called as covered, collar. Okay, so in the same way, if the stock is continuously moving down, so we can just keep selling. You can sell 1300 call option. Okay, so your buying prices, it will come down to, you can say 4%. 10% you will not go under loss. So usually this strategy, as I said, covered call and collar, these both are bullish strategy. So if the market or any of the underlying stock, if it is going up, you make a defined profit and you will have a defined loss. So you can always, this is used extensively when you have a bigger portfolio. Okay, so say suppose if you have Reliance, if you have Infosys, if you have Nifty Bees, if you have any other stocks in the F&O segment. So if the stocks are not performing, you'll just gain this. See, without buying the futures, if you already have a cash, okay, you can just see here. Okay, so if you sell this 1350 call option, say at 50 rupees, so if it is not going to 1390, if you have 500 shares of Reliance in your portfolio, okay, so here if you go for a call option sell, you will be getting 20,000 rupees if it is not reaching this strike rate. If the stock is not moving by 3.4%, if the Reliance is not going, you can sell any of the call options as per your convenience. If the Reliance is looking bullish, you can go and sell 1360. Usually we sell around highest open interest rate, whatever it is there, 1400. Okay, you can see here, if the stock is not reaching 1417, it's nothing but you sold your stocks for 1417. You will go under loss only if the stock price is going above 1417. So it's fine, right? Even if the stock goes to 1500, it's fine. You have a delivery. You have delivery, so you will not lose anything. So if it is not performing, if it is not moving 5% in a month, so you will be making 8,200 rupees, which is around 9% returns on the deploy. To sell option, and you don't have to really buy the put option if you are not having. So if you want to say, if you see the put option, you will get more returns. You will get 15% return if the stock is not going to go up by 6.2%. Below 1427 on the date of expiry, if the Reliance closes anywhere between 1390 or 13, even if it goes to 1390, 4% up, you still make 13,000 profit and your portfolio will have definitely increased. And if the stock comes down even by 10%, you have nothing to, even 7%, your portfolio value will come down, but here you will make 13,000, which is 15%. That's where whenever you feel it is a bearish, you can cut off and have unlimited profit. Say suppose if the Reliance falls down by 15%, okay, so you still make 11,400, and over and beyond that also, if it is falling 20-25%, you'll make more money here. You'll make 57,000, which is 62% of your deployed amount. Okay, that's how it works for a people who have portfolio, or if you are going long in futures, this will help. This strategy will help. I hope everyone is clear on the covered call and the caller. Quite simple strategy. So it is always good to use when you have a portfolio or if you are planning to buy it in futures. So usually what we do is if we want to go long in Nifty, we don't directly buy the futures, okay? Because futures has a high taxation and high value transactions will happen. You can create a synthetic futures, okay? How to create a synthetic futures? It's very easy, okay? You sell a put and buy a call, okay? So if I want to synthetic future, how to create it, I'll show you. 22,300, right? 22,300, you sell a put here and you can buy a call. Okay, see, if you buy a Nifty futures, you will get the same payout graph, unlimited loss, unlimited profit. The probability will remain the same. You can see the margin required is 1.36. Okay, you can just by selling a put and buying a call, it becomes a synthetic futures. So usually for the options, how much actually it is required? The turnover will come down. So the charges, the city and all other charges will come down. So it is always good for synthetic futures if you want to go long. You don't need futures at any given point of time. Futures is not advisable. If you know the options very well, okay, you can use options like left and right, however you want to. And with this synthetic future, if you want to go for a covered call, you can create it's the same graph, same thing, nothing will change. All these features, and you can this will become a collar strategy by using only options. Okay, if you buy put here, if you can buy any put as per your convenience, you can just see the support, okay, and buy the put. See 37,000 is the maximum loss. Okay, someone is asking that question. 1:1 ratio, yes, 1:1 ratio. It is like you have 60% of the uh, probability here. So maximum loss is only 37,000 and maximum profit is 27,000 with this synthetic future covered call. Okay. So let's move to the next strategy, which is put calendar spread. Okay. So let us understand what is put calendar spread. Calendar spread is nothing but so you create a strategy in multiple expiry day. Okay. It's again a bullish strategy. Okay. And we will sell the current month put and buy next month put. It's either way. As I told you, we will buy in different expiry. Okay. Here you will have a limited risk and limited reward strategy. Okay. Let's create a put calendar spread. Okay. So we'll sell current month put and buy next month put. Usually, why we do that current month and buying next month? Because the current month options, the decay will be very fast because the current month has very less time. The next month we will have more time. So decay happens faster here in the current month and decay happens very slow in the next month. So whenever there is a that's what we want, right? So if you want to the decay, we want to enjoy. So that is low risk, low reward strategy. Let's see that in Nifty and create one simple calendar spread. Okay, so Nifty build strategy. What was it? We will sell this current month. We can do that in weekly as well. I will show you with weekly options. So if you can go 7th April, we will sell current month put, which is 22,500 at 426 rupees. And we will buy a monthly put. See, you can always check out what is the delta of it, 0.5. You can go with the same strike rate or you can just go with lower strike rate. We will go for next week put option. We will buy and a put option of 22,150 or 2,400 also. You can just see. See, this is how it will be the payout chart. Minus 1%, as I said, it is a bullish strategy. So even though if it is a you have a buffer of 1%. If it comes down by 1%, you will still over and below 1%. You will go under loss, not exactly the loss because you will be long as well, and up to 3.47. See, if you have 8 days on 7th of April, even if the market closes for 0.5% or 1% down, you will lose only 184 rupees. But if it is going up on the date of expiry, this will usually exit. Even if it is going up by 1.52%, you will make 8% of the deployed amount. The margin requirement is only 69,000. Okay. Because you are not carrying any kind of loss. Practically, you will not have any kind of loss. On the date of expiry, if there is a huge movement, you will go under, but we will shift again. So you can just see here, you can buy next week. The other zero point 0.5 was this one, right? If you can buy here, or buy 22,150 put, the payout graph you will see here up to 7.5%. If it is moving upward, you will not lose anything. But on the lower side, you went 7%. You can just come to profit and loss statement. You will see here the sell if the market goes up, okay, by 2% or even 1%. This option will become zero on the date of expiry, 22,500 put, because it is closing about 22,500. And by buying in buy put, as I told you, you will lose lesser here. Only 15,000 you will be in loss. On the date of expiry, it is better to cut down both the position, or you can shift to again put bull strategy if you are bullish. So if there is a sudden crash in the market, this put option come into the profit. This put option will go to the loss. Okay, at that usually it is 6% down, but you will be covered. The maximum loss what is only 26,000. Okay, and this put option we can just keep shifting. Okay, rather than by 22,500, you can sell here 22,300. Okay, the loss will be coming down. You lose 72,000 in the current week selling, but in the buy positions you will make 56. See, from 24,000 it got reduced here. So usually the payout graph will look like this in the candle. So if you want to go for a monthly, let me show you the monthly one as well. Current month and next month. If you are usually if you trade, if you don't want to adjust on a weekly basis or something, weekly expiry you don't want to gamble with, go for a 28th April, sell here a put option, the major support level you can sell here 22,000 here. Okay. Anyhow, by just selling this option itself, you have a probability of 74,000, but who knows, the market may surprise you anytime. If you don't want to take a risk, you can go for next month, May. And cover, you can buy a put here as 21,500. So the strategy will remain like this. So up to 4.6% down, you will be covered. And upward, there is no limit. 20, even if the market moves up by 20%, you will still will be in profit. You can see here the probability of profit is 80%. So 80% probability with only 60,000 of investment. Okay. If you create this, if the market is closing anywhere between 21,302 to 27,700, so you will be in profit, right? So on the date of expiry, say suppose on 28th of April, okay, this is if the market is closing, say, flat. Okay? Even if it closes flat, you'll make 33% of the profit, which is 19,800. If it is going up, okay. So if it is going, you make 24%. it may go up by 2%. You'll make 15% of your deployed amount, whatever, wherever it goes. Even if it goes to 23,100, 200, 300, you will not lose anything. Okay, even if it goes 7%, as I told you, up to 24%, you will still make 6% of the profit. If the market comes down by even 4%, you still make 7% of the deployed amount, which is 4,500. And the bumper is when the stock is not moving here, even if it is closing flat, you make 33%. So this helps you in range trading, right? So usually the probability is very high that the market may close between 21,300 to 27,700, right? So if you don't want to go for, so very low chances are there that it will go to 24% half, right? So you can just modify this and go and buy 21,000 put. Your still range is like upper limit, we don't have even 24%. Above 4%. So if it is closing above 21,444, you make around 20% of your deployed capital always on the date of expiry. It's not only on the date of expiry. You can just see here, this is how the payout is Monday. On the date of Monday or Thursday, if market is not moving or moving on an upward side, you still make around 2.5%, 3%. Okay, you can just keep. And this in monthly, this one, I suggest not to change anything. If you're selling weekly and buying next weekly, I suggest you to book a profit once you get around 3 or 4%. You can calculate. If you are creating monthly, you just leave it relaxed. Don't come to the market on a speculation basis. This is usually all these options are meant for parking your money. Okay, you have a huge portfolio pledge because all selling is free. Even this 74,000, you don't need this margin as a cash. If you have your stocks, okay, just pledge it. The selling is free. Only the buying amount, whatever it is there, you have to keep that in your balance. Option buying needs a cash requirement. With the stock pledge amount, you cannot buy any of the options. You can sell any of the option. Okay, so that's how is simple is this is put calendar spread. Okay, next we will come to call calendar spread. In the same way, you can just go for a call option, right? There is no, because if you are bearish, so that is a bullish strategy, and this one will be a bearish strategy because we will be using one current month sell option and we will be buying next month call option. So the same rule, right? So there we are utilizing put to become bullish. Okay, here we in the call calendar spread if market is bearish. So the pivot chart I will show you here. So let's delete this all put. You can have a double calendar spread. That is the next strategy I will be talking about. Okay, build new strategy. As I told you, you will be next month call option you will buy. Okay, if you buy 23,000 call option and current month call option, you will sell. You can sell any of the call option, 23,500. See, look at the graph here. So if the market is not moving up to say 5.9% upward, so if it is closing 23,644, you will always make very good profit here. So if the market on the date of expiry, okay, that is on 27th of April. So if the market closes flat here only, you will make around 33%. Even if the market goes up, even though it is a bearish strategy, even if the market goes up, you will make very good money. Okay. All right. You can see here, it's all about how even if it goes up by 2%, 22,000 or even 23,600, you will not lose anything. This strategy is deployed when you have a huge quantity of Nifty based underlying asset. Say, suppose you have around 50 lakhs or 1 crore worth. So usually we calculate the Nifty future value, right? Nifty future value is 22,300 into 65 will come to around approximately 13 to 14 lakhs. So if you have a Nifty base worth 13 to 14 lakhs, you better deploy this strategy. If your portfolio is coming down, you will make money here. How much ever the market, even if it crashes down to 7%, you still make 8% of your profit, which is 5,500. And marginally, even if it is down here, okay, you will still earn 25% of your deployed amount. So when you have a portfolio, when you want to protect it, you can go for a call spread strategy, call calendar strategy. Calendar strategy is all about we if you say if you don't want to go for a May futures long, okay, we have bought a call option here, which is a premium of 755. You can just reduce it here and go and buy 23,500 call option. You'll still get more returns up to 4.7%. This is completely bearish strategy. You can see here, market may fall down to any percentage. You still make 26% of the capital deployed. So even if the market closes even 2.3%, 3%, 4%, how much ever it is falling down, you make 20,000. Okay, the maximum loss would be only 39,000. And don't think about this loss because if the market moves in an opposite direction, your portfolio value will increase. Remember that. Okay. So you will make a huge profit there. If the portfolio is not performing, you will make a profit here. So at any given point of time, you should make money even the market moves on a sideways or downward or upward. So you have strategically deploy your strategy and make money consistently. That what it will help in a longer run because there is no one in this world who can predict the market. Okay, so if you're taking an expert advice, go for an option buying and do some 10 to 20% of your deployed amount, total amount. You just do the buying and have an excitement trading there. But real wealth is created by these kind of strategies. Okay, I hope everyone is following me. Now let us come to the next strategy. I hope everyone got clear. Call calendar spread. So which options to take? Usually better to go with zero point 0.3 delta. If you are selling around zero point 0.5 delta, you can go and buy zero point 0.3 delta strike price. You can just create it by yourself. It's always good to experiment. It's all about, as I told, it's again about your risk. If you don't want to buy a call option at even 23,000, if you are fully bearish, you can buy and go by 24,000. The loss will increase here and the profit also increases. The probability will almost remain the same, and below 4%, you will make very good profit of 29%. So this is a monthly calendar spread. You can go and sell weekly options as well. Okay, along with this, you still make more profit. And if you add some puts to it, you'll get again a different strategy. Let's not go into that confused. Let us understand only the calendar spread now. Okay, this is called calendar spread, right? So next is double calendar. Okay, double calendar is nothing but a neutral strategy. Okay, as I said, put calendar spread. Okay, that was a bullish strategy. Call calendar spread, it's a bearish strategy. What if we combine both? That will become a neutral strategy. I will show you it's a combination of put calendar and a call calendar. Okay, it's a low risk strategy. How it will work, I'll show you just very simple. Okay, let's delete this. Let's create put calendar spread and a call calendar spreads in Nifty. Okay, as I said, you will be going and choosing April month. Okay, put calendar spread is selling put option here and buying May put option, right? You can buy any of the puts with the delta of 0.3, or you can just go and buy 21.3 delta here. This is put calendar spread. Okay. Now let us create a call calendar spread. We have to buy a call option here, right? So we will buy 24,000 call option and sell month call option. So plus or minus 6% you will get. So this will vary. Okay. So the maximum loss what you will occur is 48,000, but the maximum profit what you get is 67,000. As it is a neutral strategy, you can see here if the market remains neutral, you will gain a maximum return. See, on the date of expiry, if the market is staying neutral, you will make 51%, or in 1 lakh, you will make almost 57,000 profit. Anywhere, if it is closing 22,000, there is a high probability that it may close between 22,000 or 22,500 if you feel like it is a neutral. So you can deploy this strategy, which is a double calendar spread. So plus or minus 6%. Even if it is going up by 2%, you still make 38%. Even if it is coming down by, oh, what do you say? You can just check out here. Even if it is coming by 2% from here, if it is closing 21,700, even 3%, you will make 21% profit. Okay, this is a neutral strategy. So having double calendar. Okay, so let us move to the next strategy. Okay, ninth strategy, it is a put back spread. Okay, so what happens in put back spread? Okay, we will sell an ITM put in the money put. Okay, in the money put and buy double the quantity of OTM. Okay, so it's a bearish strategy. If you this worked out very well in this era, in this from past March month, this performance, this strategy has given maximum returns. Okay, make some money if the market turns bullish, but lose money when the market is in range bound. If it is going to range bound, we will lose, but it will turn into uh, the profit. I will tell you, like, let's create this and simulation. We have to sell one ITM, right? So we have to sell ITM 28th April. ITM for put would be 22,500 is ITM. Okay, 22,600 is ITM. 22,700 is ITM. Let's see 22,500. And we have to buy double the quantity of OTM. So OTM is again below 300. 22,300 is here. So OTM, you can just see by here. So you will buy double the quantity. As I told you, this is a bearish strategy. If the market is falling down due to the high wicks, the premiums are very high. Okay, so you can just the premiums are very high. 722,000 put option is trading at 520 rupees in a monthly option. If you do that, this will, if the market falls below 5%, you will make very good amount. Okay, from the day, as I said, if let's say if you see here on the Wednesday or the 2nd of April, if the market starts falling, say around 2%, you can see here 2%, 3%. If there is a gap down opening, as you have double the quantity of put buy here, you will make profit when the market is started falling. If you don't want to sell this, you can just go and sell. This is also ITM upon what kind of put you are buying. The double the quantity put, if you buy it, it becomes a bearish strategy, whereas your maximum profit will be unlimited and maximum loss, if it is range bound, you will make loss here of 24,000. And if it is range bound, you will lose maximum. Right? So this can be applied. I usually suggest not to go this strategy because it's purely become directional. Okay, it's not advisable. Put back spread. If you are highly bearish about the market, then only you can go and buy this strategy. In the high wick strategy, I don't suggest this put back strategy. Okay. So next comes the call back spread. Okay. Okay. It's again a bullish strategy. We will sell ITM call and buy double the quantity of OTM. So we will see here. It's better to deploy in a weekly strategy that will give immediate return. If the 7th of April, as I said, ITM we will sell it. So we will sell 22,300 or 23,300 we can sell. This becomes at the money, but it's okay. And we will buy double the quantity here, OTM. So this becomes a bullish strategy. If the market is moving up in the same direction, on Monday, if it is moving up and making money, you still make around 4,000. So if it is exorbitantly moving around about 3 and 4%, you will make very good money of 85%. So if it is going about 22,400, will make money. very good money. You may make 100%. So if you are nearly, it's just about like you collected 454 premium, but you are paying here more. The OTM you can, if you can go and buy 22,700, double the quantity here. If it is in range bound, you will lose almost everything. If it is coming down, you will lose only 4%, okay, which is 4,000. But if it is moving up, it becomes highly directional. Okay. So that's where the probability of profit is only 20%. So in a combination of in the high weeks when you are buying an options, that eradicates every thing. So if you only keep selling and if you just do a hedging, that is good for. So callback spread is what? Double back spread is combination of again call and put. Okay, good just ahead of binary events. If there is any binary events, make money when the market makes big move, right? Loss will be when the market trades in range bound. So as I said, if you have this strategy as well, by selling ITM call and double the quantity you bought it, right? Here is OTMs if you have double the quantity here. And if you sell ITM put as well and double the quantity of put bought here, somewhere around 21,800, or you can choose 21,700, double the quantity. So this is how it looks. So if there is a big movement, you will make big profit. If it is in range bound, you still make some money. You will have different level on the date of expiry. Let's see here. On the date of expiry, if the market closes flat from 22,140 to 22,500, you'll make money. But if it is closing 21,700, you will lose. And if it is closing 23,000 also, you will lose. If there is very big movement, you will make, if it is coming down by 8%, and you will make 86% of the profit. If it is going up by even 7, you will make good money. So these things are usually done in stocks when there is an event. So don't place this kind of strategies in Nifty index and all, because Nifty is like in a day it can go up to 2 or 3%. Very rarely it moves around 4 or 5%, right? So in this war situation, every day we are seeing more and more 4 and 5%, 3 to 4% of the movement every day. But in the normal case, it is not very oftenly it will not move. A maximum 1.3 to 2% what it can move. So now coming to interesting strategy, which is a butterfly. So in the butterfly strategy, you will get a wider range. So it is a limited risk strategy, okay, but immune to black swan events, okay. Number of buy must be same or more than number of sells, okay. So I will, you can play with the third leg buy. How to do that? Let's create a butterfly strategy and see. You can have butterfly strategies number of times. So usually, I personally use butterfly strategy very extensively to stay invested in the market. So I will show you a butterfly strategy, custom butterfly strategy, how to create it. So butterfly strategy is nothing but using both buy and sell options. Okay. So if you want to go for a monthly butterfly strategy, 28th April will take it. So what we will let's see. We have to how the butterfly is. It has a wings, right? So it has a wings here. So we will create a wings as per our uh, capabilities. So it's all about what kind of butterfly, how big butterfly you want, or small butterfly you want. Usually we do it for a two standard deviation. Okay. I will show you how you can build a custom based strategy here. So say suppose now it is 22,300. Now we will take the first, create a right wing by using a call option. Say suppose 23,000, I will buy a call option. Okay. I have only 29% probability. Let's make this probability to up to 80%. So I have paid 484 rupees, right? So I have to collect this premium. Okay, how will we collect? So you take exactly half of this, maybe around 250 or 300. You can see here 300, 23,500 call option is trading at 300 rupees. So what we will do is we will sell two lots. So this has become a right. Okay, with only one wing, the probability got increased to 83%. So if the market closing below 24,133, you are not on loss. So the margin required for this strategy is 1.4 lakhs, right? Okay, so this is the right wing. So to cover this, as I told, it should be same quantity of buy or more. So to protect the unlimited loss, we will go and buy an option in 24,500. So that this any given point of time, don't go for loss which is unlimited. See, until and unless you have any underlying asset. Okay, if you have an underlying asset, you don't have to go for this option because as soon as you buy this, the option. So, but whenever it is in this range, you are making very less profit because you are buying here. Okay, if you see here at this conditions, you are making 5%, and once you buy this, you still make 1.7%. Okay, by deploying, you see here 86%. By buying this from 1.4 lakh margin required, you if you just spend around 90 rupees option by buying, your loss came to limited and the margin was almost 50% reduced, right? You can just do one thing here. You can buy two lots and sell here by selling something. You can have a butterfly wing like this. See, this is the maximum two standard deviation, up to two standard deviation. You understand? In the previous class, I told you, right? And the standard deviation, if you see, 95% of the chances the market stays in two standard deviation. Okay, up to two standard deviation we have covered. So this will become a, I will go with a simple butterfly first and then you can just add on to this one. So this is the right wing and now let us do with the put options as well. So put options we will buy around, so let us see here which is the option here 21,500. Okay, so we will buy 22,000 put option here and sell 21,500. Two lots. You can see here the butterfly is created. Okay, so this is how plus 8.5% if the market goes to 22,400. This loss again, as I told you, you can just make it a limited loss if you buy 20,500. Okay, if you are not sure, if you want to go for, if you are expecting any black swan event or any negative news, you can create here by, you can just see here. Okay. You can buy 21,000 put and sell 20,500, double the quantity. What happened here? Okay, here we have got it. That's right. Okay. So if you see here, it's a big butterfly up to 11% if it is coming down. On the date of expiry, let's see here. You have a wide range of minus 11% and plus 8%. Okay, even if you want to keep unlimited on the upper side, you just don't have to. You can just cut down the wings of the butterfly. Just don't go, you can just go 1:1 and don't buy this option. Okay, rather you can sell these options and make it profitable. You will not anything rather than selling 24,000, you just have to sell 24,000. So plus or minus 11%. Okay, plus or minus 11% in a month. Okay, there is no probability of profit showing here because It's usually the maximum loss is unlimited, but you can just make it limited if you are buying any of the put here. But usually here, the market may move on the date of expiry, 28th of April. You will make 2.4% if the market is in range bound. So you deploy the butterfly strategy and go for if it is neutral. On a weekly one, we can deploy straddles and strangle a naked without buying an option. Okay, see if the market goes up. Okay, the market always tends to move up if the wars and all to over. So if the market goes up by 3%, 4%, okay, 5%, okay, even you will make 13%. The margin required is 2 lakh. Okay, even if it goes by 5%, 4%, you make 34,000. Even if it is going by 5, 6, 7%, okay, there is no, you will be always in profit wherever it goes. And say, suppose here you will get a maximum profit. Okay, if the market coming down the other direction, as I told you, a wide range, plus or minus 11%, wherever the market closes, you will be in profit. Okay, say suppose market comes down, okay, by 6%, you'll make still 4%. If the market is down by 8%, you'll get again 17%. Maximum profit happens here and here. So it's all left to you which wing you have to create it. You can just, if you just remove, as I told you, we are buying one lot buy and two lot sell. Okay, you can just change it to anything you want. It's all about fixing a ratio here. If you are still, what do you say? You can just sell here as well. Okay, so this strategy, if you see here, I don't want to, because upper limit, if you don't want to keep it, minus if the market is closing anywhere between 20,000 and above, you will be, but you can see here the whole thing. See, if it is market is closing from 20,900 to 22,900, you will make 2% of the deployed amount. If it is going above, you will make 7%. Unlimited. Upward, there is no limit. Okay, and even if the market comes down by 8%, you will make 23%. Okay, you will go under loss only when there is market is going beyond 10%. Okay, if it is going in a to protect that, you can just buy one put. Okay, so you can just buy any of the put here. You can just make it 1:1 as well. Okay, you can just buy this put and leave it. Usually it's not required. Usually, yeah, it's not required. It's always to be in a butterfly. You can buy this and this. You can buy this 300 rupees premium and collect 500 rupees premium. Okay, up to 2 standard deviation, 8%. If you want to go unlimited downside and upward, you can just reverse it by not buying a buyer call option buy. Okay, if you don't buy here, okay, this is how it is. So anywhere if the market is closing below 5%, if you don't want to 5%, you can go and sell any of the options in a far away. Okay, so if you can just sell it here, 24,000, this will become up to 8%. If the market is not performing up to 8% anywhere, and if we in this range, you will get maximum profit, but anywhere below 24,100, if the market is not moving to 24,000, you will make 6% of your deployed amount. Usually, you can reduce this amount and make it still profitable if you are happy. So the amount will come down. You will lose 28,000, but you will gain 36,000 maximum if it is coming to here. But anywhere between here, you'll make good profit. In likewise, so butterfly strategy is that one lot, if you buy, okay, you have to collect two lots. You have to sell two lots. And to hedge the position, you have to buy one lot. So two lot sell on the call side. Okay. You can choose any of the strike rates you want. So it's all about the profit margin, how much you are expecting. If you want, as I told you, usually we go very near to the market. Okay. So I'll just delete one thing and usually I'll tell you what kind of butterfly we create. So usually we will buy this. We'll be very near to the market because we do a lot of adjustments. Okay. So we stay invested like this. So this is a 100% probability strategy. Okay, there is no loss. No one. Usually we stay in this kind of. We park our the whole amount in this kind of strategy. Okay, people get scared and go and sell all very far OTMs and not collecting the premium without understanding. But the real mathematics works is, see, wherever the market goes, there is no range at all. You can just see here, there is no range on the date of expiry. Okay, we will see if the market is flat, we'll make 16% of the profit on the deployed amount. The amount required to build this strategy is only 1.14 lakhs. At any given point of time, you will not lose, you will only gain. But in this range, 22,000 to 22,800. There is a high probability the market will close here. With this strategy, we go for a weekly buying, weekly. With this strategy, you can always do whatever you want in the weekly options. So to park your money, use this kind of strategy so that whenever the market is in range bound, we will make good profit here. I hope you got my point. This is a custom butterfly strategy. It don't look like a butterfly strategy, but yes, this is a different kind of wings. This is a left wing and this is a right wing. You have to find the butterfly there. Okay, so that's how it is. So usually, I hope everyone is following. If you have any questions, raise your hands. I'll be happy to connect. So I think we have covered most of the strategies today. Okay, I think for today, this is the we will have one more on day after tomorrow. Okay, because tomorrow I have again a webinar and I have a tight schedule. So on day three, cover all the other aspects like the remaining strategies we will learn and how to what are all things left. So butterfly. Okay, iron condor, iron fly, portfolio hedging, technical analysis, and we will see about management, risk management. Okay, so I think in next workshop we will cover all other things, and that will be we have covered. Next, we will come to iron condor in the next session. Okay, anything, any doubt, guys? You can unmute and talk to me if you have any doubts. I see a lot of people only listening, not talking to me. Hope you are following. Otherwise, how will I understand? In the sense whether you are new or not understanding, or you are understanding very well.
Hello, sir.
Yeah, hi. Amir.
Hi, I am Ramesh from Kerala.
Yeah,
I am
hi.
just new to this field and I want to know more about the share market. But during the travel, I cannot follow more and more. So, will you please share the
Mhm.
recorded class
Yeah,
in
I
the
will
group?
be sharing this recording. You can just go through slowly because this is
Okay, okay.
a bit advanced one. As you know, our app can give auto investment, stock ideas, and future and options ideas. So this
Okay.
will help you managing the whole portfolio. Okay.
Okay, okay. Will you please share the yesterday's class and the today's class too?
Yeah, today's classes also.
Okay. Thank you, sir.
Yeah, you can type the question, Rasman.
Okay, okay. Your class is
Okay.
very nice. I was very interested, but due to some technical issues, I am on traveling. I cannot follow the
No
almost.
issues. You will get the recording. You can just go through. I am planning to keep
Okay.
all these recordings in our app so that whenever you find the time, you can just go and look at and understand. And you can join this workshop if you're a subscriber. You can join any workshop free of cost. In the
I am a subscriber from the last few days.
hmm.
I am a subscriber.
Yeah, yeah. I mean, this is only for our subscribers. I'm giving this for free.
Okay, okay.
All
Thank
right.
you, sir. Thank you for your kind cooperation. Your class is very nice, very easy to learn more and more. Okay, thank
Yeah.
you.
Purpose is to educate people. Told you I am doing it with my passion. Whatever mistake I did it in around 10, 12 years back, nobody was there to teach me on option selling and all. Right. So exactly the major money happens there. Okay. So
Okay.
thank you very much.
Thank you, sir. Thank you for your effort.
Yeah. Your mic is not working. You can just check. Okay. Why to check delta before buying an option? See, delta indicates, see, I'll tell you what is the delta. The stocks for and for index, for example, second. 11 for stock. Example for star 11. What is that star 11? Can you tell me the strategy for stocks and for indexes? Butterfly strategy. When you want to reach maximum profit, that is at the peak, can you exit strategy? In the butterfly strategy, when you reach the maximum profit at the peak, you can, yes, you can exit anytime. When it is at the peaks, I always suggest to go for an exit. Correct. You have to exit at the peaks because otherwise, no meaning, right? Whenever you find a good profit, you just exit and create one more strategy. See, the Nifty will be keep moving in this week's happens, right? If you're in peaks profit, just exit and create one more butterfly. Okay, and any other questions in the stocks? We will see. In the stocks also, if you want to, I will just show one stock butterfly strategy because it's all in Nifty what we have done, right? You can just clear and you can see if you want to build a Reliance. Okay. It's very simple to build any of the butterfly strategy, even in the option 28th April. The only thing you have to buy 1400 call option, 27 rupees premium sold. We will sell two lots here and one. Okay, so you can just you can or else you can go and buy 1500. This is right wing, or if you and go and create two lots buy and two lots sell. Okay, so here you can buy. Usually it has already fallen down. I go and buy the put option at delta. I'll explain you the delta in the next class. Okay, you can buy double the quantity here and buy one put option here. So this will be a butterfly strategy with a right wing very clear for Reliance. Okay, and if you want to create bigger butterfly here, you can go and buy 1450 and sell 1470 call option two lots. Okay, and not buying here. So you will get a range of minus 16% to 11%. But if you want to go for, usually it purely depends upon the stocks. Okay, to have this butterfly, the not that great here to build a battery strategy. You have to go for very nearer option. Okay, like this you can create it. See, if you see the Reliance, the maximum call and put is in 1400. So not to buy this, you can just go for call bear spread and have this strategy for Reliance will help you. A limited loss of 25,000 is closing below 6% to 16% down. You can just cover it. Okay, we will discuss more about this and all when it comes to portfolio management. I will be covering more on the stocks and all. And in the technical analysis also, I'll be giving it. I'll be explaining more on the stock side. Okay, thank you guys. I think for today, that's it. Uh, you can leave your messages at bot in the chat. I will just see what best if I can reply. If not now, today, I will be just doing new to option trading. Used to be an investor. Now portfolio is 10 to 20% down. Please advise. Ram sir. Don't worry, your portfolio, as I told you, this session is to, if your portfolio is not performing, you should have some income, right? So that's how you can use covered call. Okay, what portfolio you have, you can just tell me how to protect it. We will do that. If you have a bigger portfolio over and above 5 lakhs or 10 lakhs, then only it makes easier for you to protect your portfolio. If not, you have to wait, use our auto investment bot. Okay, then that will help you a lot in handling your portfolio. Okay. Okay, that's it for today. We will meet day after tomorrow with all the to cover all the other strategies. Let me stop recording.